Hugh, you're a historian. Is Madoff just an example of what happens, like the tulip frenzy, like John Law and the creation of money and how that all went out of whack? Is it just a function of excess liquidity and speculation that you throw up these scammers? I mean, Charles Ponzi was thrown up in a similar period, it seems.
Similar period. The one, if we seem to draw parallels with 1929, and the Madoff of 1929 was the chief executive of Swedish Match, the Scandinavian moist tobacco business, and again he did a scam. He suckered the world, if you will, and therefore it seems to coincide with. It's not the stupidity is a strong word. It's not the stupidity of those involved. It's rather the greed of those involved, that they didn't ask enough questions about it. But it certainly seems to be an episode which is linked to, as you said, the creation and the surplus of monetary policy, which does ferment into speculation, and this is a speculative excess. But the excess, as I say, is the lack of scrutiny. And we see a lack of scrutiny across the board in terms of the pricing of assets, not just in these very rarefied examples.
Did you want to come in, Lucy?
Well, yeah, I'm just wondering how you see the role of the SEC. I mean, is the SEC's role going to get stronger, or is the SEC going to be kind of put on the sidelines and other regulatory bodies are going to take centre stage instead?
There will be more regulation, I don't think that's necessarily the answer. If we look at the debacle of the banking sector, the banking sector is the most tightly regulated industry, apart from nuclear perhaps, in the world. If we look at Fannie Mae and Freddie Mac, which are no longer with us in the private sector, again, the most scrutinised businesses in the world, and they blew up, right? So regulation isn't the answer. The best thing is that you have a very sharp pencil pressing against your spine, That means that you scrutinise things. Being on risk means that you scrutinise things. The problem that we had, and Bernie typifies it, is he was respectable, How on earth would you fault him? And we have this devious gene in our minds where we are suckers for respectability. If you look at me, I can't raise money. People they say, look at that crazy guy. But that crazy guy is that sharp pencil on your spine that makes you money when everyone loses it, that insures you when you just get a little bit naughty. That's what the crazy guy gives you. Hedge funds in the 1970s, they were crazy guys. And the regret was that you never gave them any money, because my goodness, they were fantastic with their wisdom, they were entertaining, but they just weren't respectable, and you regretted it for the rest of your life. And the lament today is that too many institutions have become respectable, and hedge funds very much lead that list. They're no longer cavalier or pirates, they're the Royal Navy. And that's the wrong turn that I believe we took maybe 2 or 3 years ago.
So you've ditched the Savile Row suit and the tie. And you've
the tie's there.
The collar open.
I've given.
And the
I'm doing yoga.
Okay. Let's get back to the markets for a moment here, because
markets, but
yes, but the risk trade, and why the risk trade you believe is going to break down here. A couple of our audience have written in and said, is there a chance? Hugh Edward, for example, in London, writes in, do you think that the earnings season will finally be the reality check that this market needs to get back to more realistic equity prices? Clearly he feels that the market needs to go down. The recent speculative rally in commodities and equities seems to have been purely technical rather than based on any fundamentals. But you've got a good line that ties in the Chinese yuan and the activities of Chinese speculators with this appreciation in commodities and this risk trade. Let's talk about that and why you think it's the case.
Well, first of all, I think one should be wary of emphatic declarations with regard to the future. And as periodically when I have a naughty glimpse at the show and other guests that you have on, I'm always struck with how emphatic they are. The dollar will go down, gold will go up, etc. So this is the future. I haven't seen the future, and it's conjecture. But I have a chart, we've got it on the screen, and it shows a remarkably tight correlation between the oil price and the value of the Chinese currency, the renminbi. Now, for the last decade, the story is China, yeah? And the Chinese currency is too cheap, and they have this wonderful competitive advantage for all these people and productive capacity and a cheap currency. They've been under pressure, and the currency was appreciating. Now, in that environment, what happens is, I'm a Chinese speculator. I borrow money in dollars because I know that as my currency appreciates, I'm going to have to pay less and less money back. Now, I've got to do something with the money, so I take risk, and I buy equities, I buy gold, I buy oil. Oil is more risky. Now, as we hit the third quarter of 2007, the US goes into recession. It's the first economy going into recession, and what they do is they bring interest rates down. Now, at that point, not only is my Chinese currency going up against the dollar, but suddenly the interest that I'm being asked to pay has collapsed to nothing. So I'm just having a big party. I want to borrow as much money as possible in dollars. So the renminbi kind of accelerates in its strength, and all of this liquidity gets thrown into the oil market. This is this time last year, Jeff, and oil goes to $150. It goes up $50 in 7 weeks, and we're all sitting there going, wow. Right? Now, my only point to you is the one non-confirmation in the world is that since July, the Chinese currency has done nothing, has gone flat vis-a-vis the dollar, right? And in doing so, that took the crutch away from oil prices and risk, and everything collapsed, right? So there seems to be something in that relationship. If you see on that chart, as soon as the renminbi stops appreciating, the floor gets taken away. Now, this year, of course, there's been this enormous bounce, rally, bull market, call it whatever you want, but prices have gone up in risk assets. The one non-confirmation is the Chinese currency isn't going up. So my take on that is they're still struggling. Of course they're struggling, yeah? America's down on its luck. The export market is weak. If you look at rail loadings, if you look at ship loadings, if you look at activity going through ports, business is profoundly weak. The strongest part of the economy is the stock market, yeah? And until that changes, the Chinese will not allow any appreciation in the currency. So we don't have to entertain that fantasy and pathetic debate where we pretend that their GDP is growing at 8%. It's not, right?
But the currencies haven't really moved across. I mean, if you look at the dollar-euro, for example, it's completely flat. Also, since the beginning of this year, I mean, it's not just against the Chinese currency.
No. If you look at the euro-dollar, as we had the collapse in risk, the dollar went up. The euro fell from 160 to 120. Yeah. It's no longer at 120, Louisa. Yeah, it's now 140. So you're having movement. The dollar is 5% weaker versus the euro on the year. The renminbi is the one that hasn't done a thing. And as I say, in my crazy head, in this day and age when everyone is anticipating inflation, not just inflation, hyperinflation, I'm saying to you, what if we saw it? What if we saw it between 2002 and 2007, and it wasn't the quantitative easing of the Federal Reserve, it was the mercantilistic trading policies of the surplus countries, which kind of suppressed the value, kept their exchange rates cheap, and therefore created these foreign exchange reserves. These sovereign wealth funds are really just quantitative easing programs. And if we look at that 5-year period, gold broke a 27-year trend and actually went up. It went from $250 to $1,000. The dollar lost 40% of its value. 40. That is one of the biggest collapses in the dollar ever. 40%. Oil went from $10 to $150.
Which is maybe why we saw those reactions, because of the dollar collapse.
As I say, but maybe we've had all the inflation, and today prices are falling. Retail prices are falling, and yet everyone wants to talk about hyperinflation. So I'm just curious at these shifting plates and how they don't seem to be aligned. Expectations versus reality are a little bit skewed.